Hello, and welcome to Calmvestor podcast. I am Ethan. Join me on this journey to build solid financial thinking and take control of your financial future. Have you ever heard of the tulip mania? Back in the 17th century, people in the Netherlands went into a frenzy buying tulip bulbs, pushing prices to astronomical levels. Many jumped in simply because they saw others making quick fortunes, or because the news of rising prices was everywhere. Then, just as quickly, the bubble burst, leaving many financially ruined. This isn't just an old story. Similar patterns repeat with various assets, driven by hype and readily available information. It's a powerful reminder of how easily our judgment can be swayed. Think about it. Do you ever feel a strong urge to buy a stock immediately after reading a glowing news report about it? Or perhaps you felt panicked to sell everything when the market is flooded with negative headlines. If so, you're not alone. Research suggests that individual investors often tend to buy high and sell low. One of the culprits behind this is a cognitive bias well explored today, heavily influenced by the news we consume. The most dangerous thing in investing can be thinking you know something for sure, especially when that certainty comes from information that's just easy to access. My friend, for instance, always seemed to chase hot stocks based on social media buzz, and the results were rarely what he hoped for. Today, we're diving into something called the Availability Heuristic. It sounds complex, but it's a simple mental shortcut our brains use. Essentially, we tend to overestimate the likelihood of an event or the importance of information if it comes to mind easily. This concept was introduced by Nobel laureate Daniel Kahneman and his colleague Amos Tversky, pioneers in behavioral economics. They showed how these mental shortcuts, while often helpful, can lead us astray in complex decisions. Why is this particularly dangerous in investing? Financial news is often designed to be attention-grabbing, vivid, and emotionally charged. Think of dramatic headlines or sensational stories. These are precisely the kinds of information that stick in our minds. As a result, investors can be swayed by surface-level, short-term information rather than engaging in deep, long-term analysis. Our brains are wired to process information quickly, which is a natural mechanism, but it's not always accurate for investing. Kahneman himself said, "We often make decisions based on what easily comes to mind, not necessarily what is most important." Imagine a series of articles praising tech startups. You might start believing any tech investment is a sure win, ignoring the high failure rates in the sector. So what are the concrete negative impacts of this availability heuristic on your investment decisions? First, it often leads to emotional decision-making. You might buy or sell based on fear fueled by bad news, or greed amplified by good news. This can also lead to herding behavior. When many people are talking about an investment opportunity, perhaps because of widespread news, we tend to follow along without our own independent assessment. The readily available opinion of the crowd becomes our guide. Availability heuristic can also cause us to misjudge risks and opportunities. We might overemphasize dramatic negative or positive events that are heavily reported, while ignoring the broader picture and fundamental factors of an investment. Think about selling potentially great long-term investments just because of short-term negative news that dominates the headlines, or conversely, jumping into an overvalued asset because of a string of positive news, effectively buying at the peak. This often results in buying high and selling low. We get swept up by positive news when prices are already inflated, and we panic sell when negative news appears after prices have already fallen. It's a cycle driven by readily available, often emotional, information. Warren Buffett's famous advice, "Be fearful when others are greedy, and greedy when others are fearful," implicitly warns against this. It suggests going against the crowd's sentiment, which is often shaped by the most available news. Consider a market downturn. Negative news is everywhere, creating an atmosphere of fear. Many investors sell good companies at low prices, only to regret it when the market recovers. The vividness of the crisis overshadows long-term value. Why is our brain so susceptible to this, especially with financial news? It's partly a survival mechanism. Our brains evolved to prioritize vivid, easily recalled information for quick decisions. This was useful in ancient times, but can be a handicap in modern finance. We're also bombarded with information daily. To cope, our brain uses these mental shortcuts, like the availability heuristic, to filter and process everything. It's an efficiency measure, but it can sacrifice accuracy. The nature of financial media plays a role too. News outlets often focus on sensational events and strong fluctuations to capture attention. These aren't always the most crucial pieces of information for your long-term investment strategy. Emotions are powerful. News that evokes strong feelings like fear, excitement, or the fear of missing out, FOMO, is more memorable and easily retrieved by our brains. This gives recent emotional news undue weight in our decisions. Finally, overconfidence can creep in. When information comes to mind easily, we tend to believe we understand the situation better than we actually do. This can lead to rash decisions based on incomplete or skewed data from recent news. Our brains are not intuitively designed to understand probability and statistics deeply. We are easily swayed by what's prominent, not necessarily what's statistically significant. A viral rumor about a company, even if unverified, can trigger a sell-off due to its high availability in people's minds. So, how can we combat this availability heuristic and make more rational investment decisions? The first step is awareness, but we need practical strategies. One powerful approach is to build a systematic investment decision-making process. This means establishing an objective framework to reduce the influence of immediate emotions and news. For example, create an investment checklist. Before considering any investment, define your key criteria. Your checklist might include things like price-to-earnings ratio, price-to-book value, revenue growth, profitability, cash flow, competitive advantages, and the quality of management. Refer to this list before acting on any news. Seek diverse information. Do not rely on a single article or news source. Consult financial reports, analyses from reputable and varied firms, and even information about competitors. Get a fuller picture. Practice critical thinking. When you encounter a piece of news, ask probing questions. What does this news mean for the next 5 or 10 years, not just tomorrow? What are the underlying assumptions? What if this news is incorrect or only temporary? Focus on intrinsic value. Learn to estimate what an asset is truly worth based on its fundamentals, rather than just chasing market prices that fluctuate with the news cycle. As Benjamin Graham said, investment is most intelligent when it is most businesslike. Imagine investor A reads good news about stock XYZ. Instead of buying immediately, they pull out their checklist, examine financial ratios, compare it with industry peers, and read counter-arguments before deciding. That's a systematic approach. Another powerful technique is to practice time delay and keep records. This creates a buffer for reflection and helps you learn from your decisions, avoiding impulsive actions driven by the latest headline. Implement a 24 or 48-hour rule. When a hot piece of news, good or bad, makes you want to act instantly, commit to waiting for a day or two. During this cooling-off period, the news might evolve. More information may surface, and your emotions will likely stabilize. Keep an investment journal. Record why you buy or sell an investment, your emotions at the time, and what information influenced you. Reviewing this journal can help you identify recurring patterns of behavior and learn from past mistakes, especially those driven by the availability heuristic. Learn to distinguish signal from noise. Filter out the loud, short-term news that has no lasting value, the noise. Instead, concentrate on information that truly affects the fundamental prospects of your investments, the signal. Accept uncertainty. No one can accurately predict the market all the time. Do not try to react to every piece of news. Building a diversified portfolio is a key strategy to mitigate risks that arise from unpredictable events or your own cognitive biases. Investor B sees very negative news about a stock they own. Instead of immediately selling, she waits 2 days, does more research, and realizes it's a short-term issue not affecting the company's long-term outlook. Discipline, as Jim Rohn said, is the bridge between goals and accomplishment. To wrap up, remember that the availability heuristic is a natural part of being human. Recognizing its influence is the crucial first step toward controlling it. Don't let the most easily remembered news dictate your investment strategy. True investment success rarely comes from reacting to every news flash. It's built on patience, discipline, and a clear, long-term strategy. Think about investors like Warren Buffett, who famously maintain their composure and focus on long-term value despite market noise. You have the power to overcome these psychological traps. By understanding how your mind works and applying these strategies, you can make smarter financial decisions for your future. The journey to becoming a wiser investor starts with self-awareness. So here's a small action step for you. The next time you read a piece of financial news that makes you want to act immediately, pause. Ask yourself, is the availability heuristic at play here? Try to apply one of the solutions we discussed today. Perhaps it's the 24-hour rule, or maybe you'll start drafting your investment checklist this week. Small changes can lead to significant improvements in your decision-making. Thanks for listening. If you found this content valuable, don't forget to hit like and subscribe to the channel. See you in the next episode. Have an amazing day filled with positive energy.